Hello and welcome everyone. I'm Prashant and this is the ninth episode on my channel. Today I'm discussing about the building blocks of technical analysis, foundation on which technical analysis depends upon. Because I've seen many traders trading based on indicators or price action strategies, trading based on indicators or price action strategies, but they still lose money in the market and they end up blaming it to the market. However, they do not realize that they are still lacking in the basics of technical analysis. They are still lacking in the basics technical analysis depends upon. So there are few things which every technical analyst must be aware of, which no channel or blog discuss about. That is what I'm going to discuss today. What all you should be aware of before you start trading based on technical analysis. There are foundations on which technical analysis depends. They must be clear before you are even using technical strategies, because just learning a technical strategy would not earn you money. However, once you understand the logic behind those technical strategies, those entry and exit signals based on technical analysis, based on indicators, or based on any technical analysis tool or technical analysis strategies, once you understand the logic behind it and the foundations of those logic, then it will be easier for you to earn money trading based on the technical analysis. So that is all I'm going to discuss today in this video. Stay tuned and I'll be right back. Alright, before I start, I would like to give you a short introduction about myself. I am Prashant Jain, trading and investing since 2012. Indian stock market has given me the life I always wanted, I always dreamt of. I always wanted to travel and earn money. Indian stock market has given me the life I always wanted to have. I always wanted to travel. I always wanted to earn money doing nothing, which is what I have been able to do. You can also follow me on Instagram. My Instagram username is written below. And let us begin discussing the building blocks of technical analysis, the foundation of technical analysis. Okay, so first and foremost, market structure. Whenever you are trading based on technical analysis, there are two kinds of analysis which you can do to earn money in stock market. First is financial analysis. You can analyze the reports of the company, of the stock, profit and loss statement, balance sheet, all those reports. And also I have created a video series which is the fundamental analysis video series. I will put the link in the description or in the I button. You can go and watch how you can analyze the stock fundamentally. So I have discussed all the fundamental analysis methodologies in that video series. And the second is technical analysis, which most of the traders use to trade. So what technical analysis means is reading price movement. So when we are reading a price movement, we need to understand the structure it forms. I've created a drawing which shows the structure of the market for you to be able to understand and more clearly. This line is the price of the chart, the price of the stock. It goes up and then it goes down. It goes up and it goes down and it continues. That is how stock market goes. It goes up and it goes down. It gives opportunities to a buyer and to a seller to be able to earn money. As long as you are a disciplined trader. What do I mean by disciplined is you follow your rules, you follow the risk management, you have your psychology strong. And I have also created videos discussing about trading psychology and risk management. I will put the link in the I button or in the description. You can go and check out those videos. It will help you trade more clearly. It will give you more clarification on your trading, and you would be able to trade emotion free when you will apply those trading psychology strategies and risk management strategies. Now, coming back to the topic, we are discussing about the market structure. So what is the structure of the market? How it forms? The basic structure of the market is the price. It goes up it goes down and it goes up. Now, when it goes up, there comes a point where buyers exhaust and they are no more willing to take the price up, or they start booking profits. So let's say this is where the price starts. It goes up, and at this point of time, from here, the price drops. It goes up again, trying to go up further, but again, it drops. So what happened is, at this point, this is the resistance zone. What is resistance? Resistance is the point where sellers enter, where there is more supply than demand. So whenever price tries to go up from this point, sellers, they sell their holdings of that stock. So price moves down, forming a resistance zone and also forming a trading range, because from this point price is trading in a range. It is not going up from this point, it is not going down from this point. Now what happens is, when all the quantities have been purchased, so here we see that the price is going up, going up, going up. So at this point, buyers want to book their profits, so they want to sell, and sellers, they want to buy. So when buyers started selling their positions and sellers started buying their positions, so they have started absorbing their positions. So at some point, they have absorbed all of their quantity. What it means is that there is no more demand left and there is only supply in the market. So the basic law of any stock market is demand and supply. When demand is more than supply, price will go up. When supply is more than demand, price will go down. So at this point, when price reversed, there was no demand and there was more supply. So it means that supply is more than demand. Now what does that mean is, when supply is more than demand, market will fall, and market has fallen till this point. And by the way, this line is a 30-week EMA line. The price dropped. So few of the buyers who have their stop losses here, their stop loss hit and they exit. And those few exits forms a pullback. So market rises for a full pullback, taking a resistance on 30-week EMA line and then started dropping again. It falls, 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 falls. Now at some point, sellers have sold all their quantities to buyers. So when from here, when sellers were selling their quantities, their positions, buyers were absorbing them. So they absorbed, price reached at this point, then sellers again started selling their positions. Until this point, buyers again absorb it. They again sold their positions, buyers again absorb it. This forms a range. This below is the support zone where buyers are taking entry. This above is the resistance. Was the resistance zone where sellers were selling their positions and buyers were absorbing them. Now at some point, the price breaks above this trading zone, this trading range. So all the sellers who have their stop losses, they got hit and they exit from here. So that's why there is a little drop, which is a pullback, took a support on 30-week EMA line, and then price started rising again and again and again. So this is the structure of the market. Price goes up, it forms a range, then price goes down. Before it moves down further, you will always, if not always, but most of the time, you will see a pullback. Then price falls further, and then it will form a support zone. You will see buyers absorbing sellers, and then there will be a breakout. Then you will also see a pullback, if not always, but most of the time. And then price will rise again. This is the structure of the market. That is how all the stocks work. So whenever you see a chart, whenever you are analyzing technically, do not just plot indicators and wait for the signal to come to take entries. Also, understand the structure of the market. Where exactly you are. Are you in trading zone or trading range when you are taking entry based on indicators, or you are at the time when market is falling, or you are at the time when market is rising? So you need to know where you are when you are trading, when you are taking entries. That is important. Once you understand that, once you start paying more attention to that, you will have less chances of your stop loss getting hit, and you will have more chances of making profit on your trades. So that is all what market structure is all about. Second point is trendline and its angles. Most of us draw trend lines If you don't know how to draw trend lines, I'll make a video on it. I'll tell you how you can draw trend lines easily. But trend line is what used by most of the technical traders. They draw trend lines and they trade based on trend lines, based on breakouts or reversals on trend lines. Now, when you are drawing a trend line, when price is rising and you see a breakdown, the angle of it should not be too steep, because if the price is falling and you see a break above and you see a breakout, it is a weak breakout because price has been falling. It could be a little pullback. It could be a short pullback for sellers to grab more positions to earn more profit. They will buy the stock to show you that there is a breakout, so more buyers can enter. And when they will enter, price will rise. And when the price will rise, they will be able to sell the stock at a higher price level, giving them or earning them more profit. So whenever you are taking entries based on trend lines, always pay more attention to the angle of the trend line. That is important. Market trends. You should also know the market trend, whether you are taking a short entry in an uptrend or buy entry in a downtrend. Because when most of us trade based on indicators, the reason why it gives false signal, not because indicator is giving wrong signals, but you are catching a wrong signal given by the indicator. Indicator is not wrong. You are analyzing it incorrectly. So you should always know which trend are you in, whether the market or the stock is an uptrend, making higher highs and higher lows, or a downtrend, making lower highs and lower lows, or in a sideways trend, where highs and lows are equal. So if you're trading, if you're going long on a stock, it should be in an uptrend. And if you're going short on a stock, it should be in a downtrend. That is the basic idea behind it. Short selling is the way traders make profit even if the market falls. This is advanced trading, which I would not advise new trader or beginner trader to short sell a stock, because when stock falls, it falls very rapidly. So you will have chances to earn more money, but you would also have chances to lose a lot of money. Short selling is simply selling a stock today. I mean, you cannot sell a stock, but you can sell a future of that stock today, thinking that the price will fall further. And if it falls further, you can buy it at a cheaper price, and that difference of selling and buying will be your profit. It does not happen every time, so your analysis should be 100% correct. Because when you buy a stock, you can buy it and hold it. You will have the option to hold until and unless that stock gives you profit, you would not exit. But it doesn't happen when you have short sold a future of a stock, because there is an expiry of a stock of future contract. So you have to sell it anytime before the future contract expires. Otherwise, you would be in big trouble. So short selling is good for as long as your analysis is 100% correct. Volume analysis is also important. Volume should also be analyzed and should be given more weightage than price, than the stocks, than the indicators. Because volume tells us how many buyers and how many sellers are in the market. It tells us whether this sell signal is strong or not, whether this buy signal of indicator is strong or not. So you should always analyze volume before you take a trade. There are two kinds of volume, which I have already discussed: bullish volume and bearish volume. What is bullish volume and bearish volume? Bullish volume is when price goes up. Bullish volume is also going up. And when price goes down, bearish volume is also going down. Now, what is bearish volume? Bearish volume is when price is falling. Bearish volume is also price is falling. Bearish volume is increasing. But when price is rising, bullish volume is decreasing. Now, what it says that when price is falling, there are more sellers. But when price is rising, there are very few buyers or less buyers. Less buyers means less demand, and more sellers means more supply. So whenever there will be more supply in the market than demand, market will fall. So the concept behind the price falling and rising is not indicator, is not volume. It is demand and supply. If you understand demand and supply, law of demands and supply, reading the market will be easy. Now, how you can understand whether demand is more or supply is more? You can analyze the price, you can analyze volume. You have a lot of indicators telling you that information. So it all depends upon the laws of demand and supply, which is what market tells you. If you are able to read it correctly, you will earn profit. If not, then you will lose money. Now, I have also created a professional price action trading course. It is a beginner price action trading course, and it will provide you complete knowledge about how you can read the market like a professional and make money out of it. And what all you will learn in that trading course is you will be learning complete information you will ever need about candlestick prediction and analysis. You will also get information about market trend and structure. I will tell you in detail how you can analyze market trend and structure and how you can find out easily where you are standing, whether it is in the consolidation or it is in trending. You would also be able to draw support and resistance level correctly. I will tell you how you can do that. Again, I will also tell you trend lines. I will also tell you how you can draw correct trend lines. I will also give you information about price action tools and indicators which you can use in your trading for confirmation before you enter or before you take a trade. I would also help you analyze volume. Volume analysis is important because it tells you whether the selling or buying is strong or not. I would also tell you how to select stocks for next day to trade. Along with that, I will also tell you how and when you can take entries, when you can take exit, where you should put your stop loss. And with that, I would also tell you how you can strengthen your psychology, how many quantities you should buy or sell or you should trade with initially, and how you can go from a beginner in stock market to become a professional trader in stock market. This is what I will be discussing with you in this trading course. I will tell you everything you will ever require about trading. So if you are interested to take that price action trading course, you can send me a WhatsApp at this number. You don't have to call me because I may not be able to pick up your phone because I'm also traveling and trading, so I'm not free all the time. I also have other work. Once I receive your message, I will reply you as soon as I get time. I would help you trade and become a professional trader like I am. So I will see you in the next episode. Till then, happy trading.